I've been buying a lot of Canadian stocks lately, as I believe there's still some undervalued businesses within the Canadian markets. So in today's video, I want to focus on the Canadian markets and show you the 3 Canadian stocks that I am actively buying. I also have a few smaller cap Canadian investments that I do not share with the YouTube channel due to their low volume. These picks have been outperforming the S&P 500 by a pretty wide margin as well. My Patreon members get access to all of these stocks and my full portfolios. So if you are a Canadian investor or you have access to the Canadian markets, then consider joining my Patreon, as you will get access to all of my holdings and all of my stock picks. You will also get my Patreon only videos, access to my Discord, and real-time alerts of all of my buys and sells. So if you are interested in checking out my Patreon, then I will leave a link to join in the description of this video and in the comments section below. And with that being said, let's hop right into the video. So the first Canadian stock that I am buying in the month of April is Equitable Bank. Now this stock is in a dip off of its all-time highs of about $97 per share. It did dip down about 17%, close to 20% to $80 a share, but it has recovered now, and it is still in about an 11% correction from its all-time highs. Now, I do still think that this stock is cheap, despite its one-year performance being quite strong as well. If we take a quick look at Equitable Bank's income statement, we can see that its quarterly revenue was down over the past couple of quarters, and I do think that this is kind of why the stock fell roughly 20% after it reported its earnings. Now, it is also important to note that the last quarter was technically 4 months, and the most recent quarter was 3 months. So the previous quarter does look like it is significantly higher, but this is more normal to what the bank is actually generating in the most recent quarter. However, if we take a look at the trailing 12 months revenue, we can see that it is still at an all-time high of about $1.3 billion now, and the growth for this business has been pretty incredible. Now, if we take a look at Equitable Bank's earnings, we can see that they came in at about $102 million, whereas the previous 2 quarters were around $130 million. So the net income for Equitable Bank is also down in the most recent quarter, and this is because a small portion of the overall bank's loans, specifically in its trucking loans, have been going bad over the last quarter, and they are projected to continue going bad in the second quarter of 2024 as well. However, despite this small loan portfolio seeing some more losses, Equitable Bank did reaffirm their guidance for 2024, which we will get into a little bit later on in the video. However, again, when we take a look at the trailing 12 months net income for Equitable Bank, we can see that it is at an all-time high of about $470 million and is clearly going up still. Recently, Equitable Bank also put this in their investor presentation, which shows that the bank has returned 1,000% returns to its shareholders over the past 20 years and is now the #1 performing bank on both the S&P 500 and the TSX. So Equitable Bank is literally the #1 bank for producing shareholder returns over the past 20 years now, which I do think is pretty incredible. This next screenshot also shows that Equitable Bank's decumulation loans grew by 55% year over year to $1.6 billion. Now on the right-hand side, we can also see that insured multi-unit residential mortgages are up 34% year over year. Now, the reason that I like to see the multi-unit residential mortgages up so much is because Canada is building a significant amount of affordable housing right now, and Equitable Bank is helping fund all of this affordable housing development, and this is one of the fastest growing areas of the bank's loan portfolio now. Now, this next screenshot comes from Equitable Bank's income statement, and we can see that the decumulation loan revenue was $26.6 million on the most recent quarter. And last year, the decumulation revenue was about $12.6 million. So the decumulation revenue has more than doubled year over year. So this area of the business is growing incredibly quickly, and it is projected to continue growing at about 50% year over year. Consumer lending also brought in roughly $26 million worth of revenue in the most recent quarter versus about $13 million in revenue last year. So their consumer lending portfolio has also doubled year over year. So there are certain business segments that EQB has that are literally doubling year over year and producing significant amounts of revenue growth, which I do love to see. Now, if we head over to Equitable Bank's cash flow statement from their most recent quarter, we can see that they did produce that net income of $104 million. And then we can see that stock-based compensation was only $1 million, which is less than 1% of the company's net income. Now, if you're a regular viewer of my channel, then you know that I love low stock-based compensation, and Equitable Bank has very, very low stock-based compensation. So this is a big check mark for me. Now, additionally, we can see that the dividends paid on the common shares were $15 million on the quarter, which is roughly about 13% of the company's net income. So they're only paying out roughly 13% of the net income as a dividend to shareholders. So the payout ratio for the dividend is very low, which I do think allows Equitable Bank to continue growing the dividend at high growth rates in the future. So with that being said, let's now take a look at Equitable Bank's guidance for 2024. And here we can see that they are expecting their EPS to be roughly $12 per share in the year of 2024, and they did reaffirm that in their Q1 guidance. The dividend is also projected to grow between 20 and 25% this year, which is in line with the bank's historical growth rates of about 23% annually. So they are very much so a dividend growth stock, and as we saw, with their low payout ratio, I do believe that Equitable Bank can hit these growth rates as well. Total loans under management are projected to grow by 10% this year. Wealth decumulation loans are projected to grow by 50% this year, so another very strong year for this portfolio, and multi-unit residential loans are projected to grow by about 22% this year. Then lastly, EQ Bank customers are projected to grow by about 35% this year, so overall it is projected to be another very strong year for Equitable Bank in 2024. Now, if we head back over to Stock Unlock, we can see that Equitable Bank is currently trading for $86.57. Now remember, they are projecting to do $12 in earnings per share for the year of 2024. This means that Equitable Bank is trading for a forward price to earnings ratio of about 7.21, which I do think is still pretty dang low. And it's actually below the company's historical average price to earnings ratio of about 7 to 8. So on a price to earnings ratio basis, I do think that this is still a low price to earnings ratio for a bank that is consistently growing its earnings and revenues at about 15% annually and growing its dividend by 20 to 25% annually. Now, if we head over to Stock Unlock's discounted cash flow calculator, which now has dividends added to it, by the way, which is a brand new update that will be coming out over the next week or so, we can see Equitable Bank's fair value today. So I'm going to project out the net income or earnings over the next 5 years at a 10% annual earnings growth rate, which is actually well below the company's historical averages. I am also going to say that they are going to grow the dividend by 23% annually, which is their 5-year projections and in line with the company's historical dividend growth rate. Lastly, I am going to say that the bank is going to trade for a price to earnings ratio of 8, which I think is more than fair for this business. Now, when we enter in these metrics, we get a future stock price of $159, $13.26 of total dividends paid over the next 5 years, and a fair value of $106.75 today, which is 23% above where the stock is currently trading. If these metrics do come true, then we also get a compounded annual growth rate of 14.71% over the next 5 years, which is a very strong annual return rate that is also above the historical average returns of the S&P 500. So from Equitable Bank's price today, I do believe that it is undervalued and will outperform the S&P 500 going forward. And for those reasons, I am still buying Equitable Bank in my own portfolio and continuing to add to my position. All right, now moving on to the second Canadian stock that I am still buying in the month of April. This one is goeasy. Now, goeasy's stock price peaked here at about $213 per share in the year of 2021, and then it saw this massive correction of about 58% all the way down to roughly $90 per share in 2023. Now, personally, I do believe that goeasy's stock price got way ahead of itself in the year of 2021, and then I also believe that it got undervalued here in the year of 2023. The stock is now up roughly 80% from its lows in 2023, but I do still believe that it is undervalued today, and it is a stock that I am still adding to my portfolio. So let's take a look at goeasy's most recent financial reporting. And right here we can see that quarterly loan originations were $705 million in the fourth quarter of 2023, up 12% year over year. The loan portfolio is also sitting at $3.65 billion now, which is up 30% year over year. Annual diluted earnings per share are also sitting at $14.48, which is up 72% year over year, and adjusted annual EPS is $14.21, up 23% year over year. So net income did grow by 23% year over year. The annual dividend per share also increased to $4.68, which is up 22% year over year. So overall, it does look like goeasy is still growing its business by over 20% on an annual basis, which is incredible growth for this business. Continuing on for the full year results, this says that the business generated record revenues of $1.25 billion, which is up 23% year over year. Adjusted operating income for the year was also a record $491 million, which is 33% higher year over year. So operating income is growing incredibly well over at goeasy. Now, what's also interesting is goeasy's average interest rate has dropped to 30.3% in 2023, and it has been consistently coming down since about 2019. This is also one of goeasy's #1 objectives, is to continue lowering its average interest rate that it does provide for its customers. Now, one of the reasons that this is so interesting to me is because Canada recently announced a 35% interest rate cap on lenders. And a lot of people were bearish that this was going to affect goeasy's business in a massive way. However, when you take a look at this, again, their average interest rate is now at 30.3%, which is below the rate cap of 35% that Canada is putting in place. goeasy has also said that the 35% rate cap is not going to affect the business going forward, and they reaffirmed and actually upped their 3-year guidance when they released these earnings right here. So this 35% rate cap is a non-factor for goeasy's business, and personally, I do not believe that this is going to affect the business over the long term going forward. Now, if we head back over to Stock Unlock and take a look at goeasy's fundamentals over the long term, we can see that the revenue is currently sitting at an all-time high, and this revenue growth that the business has been seeing is absolutely beautiful. This is very consistent and strong revenue growth. If we also take a look at the operating income, this is the exact same story, but the operating income has actually been compounding at faster growth rates. And the reason for this is because goeasy has been managing to grow their operating margin massively. If we take a look here, the operating margin for the business was only at about 8.6% all the way back in 2012. However, in the trailing 12 months now, the operating margin has hit 38%. So goeasy has been growing its revenue consistently above 20% at the same time as it has been expanding its operating margin, which has allowed its operating income to compound at 30% or higher over the past decade, which is absolutely incredible. Now, if we take a quick look at goeasy's cash flow statement, we can see that they did produce about $250 million in net income for the year of 2023. Stock-based compensation was then roughly $13 million for the year, which is about 5% of overall net income. This is more stock-based compensation than Equitable Bank, but it's still a low amount of stock-based compensation in my opinion. And honestly, I do believe that the insiders deserve this stock-based compensation because goeasy is one of those businesses that just continues to impress me. Every single time they post a quarterly earnings, it meets and exceeds my own expectations. So the management at this business is doing a phenomenal job, and I do believe that they do deserve some sort of payment for that. And again, 5% of net income I do think is more than fair. Now, if we take a look at goeasy's 3-year guidance now, we can see that they are projecting about $1.8 billion in revenue for the year of 2026, which is about a 15% compounded annual growth rate to the revenue over the next 3 years. So the business is still projecting pretty strong revenue growth over the next 3 years. Additionally, the company is projecting to grow its operating margin to over 41% in the year of 2026. Now remember, in 2023, we just saw that the operating margin was 38%. So they are still expecting to continue growing that operating margin and becoming a more profitable business over the next 3 years. Now, what we can also do here is figure out how much operating income goeasy is going to produce in the year of 2026. So they are projecting that $1.8 billion in revenue for the year of 2026 and a 41% operating margin. This means that goeasy is projecting about $738 million of operating income in the year of 2026. Now, what we can do with this information is head back over to Stock Unlock's discounted cash flow calculator and use the operating income and project it out over the next 3 years. Now, $738 million of operating income by 2026 is a 15.7% annual growth rate to goeasy's overall operating income. I am also going to say that the dividend is going to grow in line with this operating income growth at about 15.7%. Now, I am also going to say that goeasy is going to trade for a 6 price to operating income, which is in line with the company's historical averages. Now, when we use these metrics, which again are from goeasy themselves, we get a future stock price of $266 per share, $16.36 of total dividends paid, and a fair value of $212.38 today, which is roughly 34% above where the stock is currently trading. This is also a compounded annual growth rate of 21.2% over the next 3 years. So if goeasy can hit these growth rates to its operating income and continue growing that dividend by strong growth rates as well, then the stock could deliver some pretty incredible returns of over 20% annually. And I do believe that goeasy's management team will hit their own projections because they do have a history of hitting their growth targets. So in my opinion, I do believe that goeasy is still undervalued and could provide some pretty strong returns going forward. And for those reasons, I am continuing to buy and add more goeasy to my own personal portfolios. All right, now the third and final Canadian stock that I want to talk about in this video is Alimentation Couche Tard, or ATD.TO. This stock is in a pretty big correction right now of about 13.5% since the company reported its earnings. Now, this is a pretty strong correction, especially for this stock. It is not often that I see Alimentation go down over 10% from its all-time highs. and I am in fact using this dip to continue adding more Alimentation to my portfolio. Now, in Alimentation's most recent earnings, they did report that same-store sales across the entire business's network are down roughly 2% year over year. So it seems like on a per-store basis, the business is losing sales or sales are going down. If we also take a quick look at the business's earnings, we can see that they were $623 million in the most recent quarter, and last year for the same quarter, they were $737 million. So earnings year over year for the most recent quarter were down roughly 20%, which I do not think the market was expecting overall. And in my opinion, this is why the stock is seeing some weakness after its earnings report. However, if we take a look at the overall gross profit for the business, we can see that it is at an all-time high now of $12.23 billion. Its operating income is also right near all-time highs, and if we take a look at the EBITDA, it is right near all-time highs of about $5.75 billion as well. So despite net income being down, gross profits, operating income, and EBITDA are sitting right near all-time highs. Now, what's also interesting is Alimentation has been using a large amount of its cash flows to buy back shares. And here we can see that the share count does continue to go down, and it's sitting at 963 million shares now. If we quickly head over to Stock Unlock's freeform tool, we can see that the price to EBITDA for this business is now sitting at 9.2 as well, which is right near its historical average of 9.28. It's actually just slightly below its historical average price to EBITDA. So this is one reason right here why I am also buying more Alimentation on this dip, because it is selling right near its historical average price to EBITDA ratios. Now, I also have some screenshots to share from their most recent investor presentation, which kind of explain why I believe this business will continue to grow over the long term, and it will get through this period where it is seeing some weakness. So right here, this slide says, fragmented US market provides consolidation opportunities. So for those of you who may not know, Alimentation is a massive convenience store operator. They have over 16,000 convenience stores across the world now, and they are heavily exposed to the US convenience store market. Now, as of 2022, there were 150,000 convenience stores just in the US. And of this market, 60% of them were single convenience store operators that were not part of some major network or major chain like ATD. In real terms, this is over 90,000 single convenience stores that are not part of some major network. So Alimentation still has a long runway for potential acquisition targets just in the US. This is not even accounting Canada, Europe, or the Asia Pacific region that ATD does operate in. So I do believe that they still have a long runway for future growth just in acquiring new convenience stores around the world. Additionally, the industry sales have grown consistently over the past 20 years. What's also interesting is that from 2006 to 2009, throughout the Great Recession, convenience store sales did grow. So this is a recession-resilient industry as well. Circle K, which is one of Alimentation's leading brands around the world, is also an EV charging station leader within the European markets, which do have a higher EV penetration. Now, moving on to the next slide, I did find this one kind of surprising. So this one says, traffic to store post-EV charger installation on site is up 8%. So after Alimentation installs EV chargers at their convenience stores, they see an 8% increase in traffic in their stores. When we compare EV customers to overall gas vehicle customers, Alimentation also sees an increased number of store visits of 11%, percent of active in-store customers up 6%, average merchandise revenue lift of 15%, and percent of active car wash customers are up 12%. Overall average merchandise and service gross profit lift is 27% when they install EV chargers at their locations. And I love to see this because I did see an argument that since Alimentation owns convenience stores and gas stations, with this overall EV push, they will see a decline in revenues and profits. But when we take a look at the actual data, that is not the case. Alimentation is actually seeing an increase to its gross profits after it installs EV chargers at its current network. So I do think that Alimentation could actually benefit from electric vehicles and charging. Now, ATD also put out a 5-year projection to hit $10 billion of EBITDA by the year 2028. This is an 11.7% compounded annual growth rate to the company's EBITDA. Now, EBITDA is also the #1 metric that Alimentation uses. Now, personally, I do not love the overall EBITDA metric, but I am going to give Alimentation a pass here because the business is just so high quality, and it is also the metric that the market seems to track the most closely. So let's head back over to our DCF calculator here and do a quick DCF calculation for Alimentation. And let's use the business's EBITDA over the next 5 years, and we are going to say that it is going to grow at 11.7% annually. The business is going to buy back 3% of its shares annually as well, which is in line with how much shares they have been buying back over the previous 5 years. Let's also say that they are going to continue to grow their dividend at about 20% annually and trade for a 9 price to EBITDA, which we saw was the business's 10-year average. When we put in these metrics, we get a future stock price of $148 per share, which is 99% above where the stock is currently trading. We also get $5.21 of total dividends paid over the next 5 years, which equals a fair value of about $95.47 per share, which is about 28% above where the stock is currently trading, which does suggest that the stock is currently undervalued. And again, remember, we are using the company's own EBITDA projections over the next 5 years. So if Alimentation does hit their own EBITDA projections, then the stock could compound at about 15.57% annually over the next 5 years, which again is above the historical returns of the S&P 500 and is actually some pretty dang strong returns over the next 5 years. So for these reasons, I do believe that Alimentation is undervalued right now, and that is why I have continued to add more of it to my own personal portfolios and to the YouTube portfolio. I will be doing a YouTube portfolio update here because I have done some moves within it over the past month. And again, my Patreon members know the moves that I have made. I've sold off a couple of stocks and I've used that capital to add it to a few stocks and buy a brand new stock. And again, my Patreon members know all of the moves that I have been doing in the YouTube portfolio, in my personal portfolio, and they know all of the stocks that I have been buying that will never make it onto the YouTube channel. So again, if you are interested in tracking my portfolios in real time and knowing what I am buying and selling in my portfolios in real time, and also getting all of those other perks, then please consider joining my Patreon. It's also the #1 way to support my YouTube channel and all of my content. But that is going to wrap up the video for today, everyone. And please let me know your thoughts down below on these 3 Canadian stocks. Do you also believe that they are undervalued today? Are you buying them as well? Or do you think that I am wrong on my analysis here? I would love to hear all of your thoughts down in the comment section below. But with that being said, that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it. And I really hope to see you all again in my next video.